Welcome to the debate. Today, we're diving deep into the fascinating interplay between what we think wealth is and the powerful, often hidden psychological and systemic forces that truly shape our financial lives. Our discussion takes its cues from several insightful chapters in the psychology of money, including Wealth is What You Don't See, Save Money, Reasonable Rational, and Surprise.
Yeah, some really core ideas there.
Exactly. And the big question we're wrestling with is this. Is achieving financial well-being more about uncovering the fundamental, sometimes counterintuitive truths about how wealth actually works? Or is it primarily about skillfully managing our own psychological responses to a world that's just, well, inherently unpredictable?
A classic tension.
It is. I'm going to argue for the profound importance of understanding those core, often unseen, mechanics of building and sustaining wealth.
Okay. And I'll be taking the other side, arguing that our ability to adapt, to roll with life's punches, and navigate our deeply ingrained human biases. That's the more critical factor for financial success.
All right. So my position is that true financial well-being fundamentally hinges on recognizing that wealth is almost always an invisible construct. It defies those flashy, superficial appearances and often contradicts our common assumptions. Think about it. As the material explores in Wealth is What You Don't See, what we visibly spend isn't wealth at all. It's pretty much the exact opposite. Real wealth is the money you don't spend, the capital that's quietly accumulating, giving you options and independence down the line.
The unseen part.
Precisely. We see this so vividly in contrasting stories. You have the extreme example, maybe, of the tech executive burning through cash on lavish displays, even skipping gold coins into the ocean, only to eventually face bankruptcy. And then you contrast that with someone like Ronald Reed, a janitor who, through decades of consistent, unseen saving and smart investing, amassed an $8 million fortune.
Quite the contrast.
It really is. The powerful insight here is that financial power isn't in the car you drive or the mansion you own, but in the unseen freedom and options afforded by what you don't spend. That's the real wealth, the capital for future choices, not, proof of past consumption. And that's why savings, as highlighted in Save Money, shouldn't just be seen as idle capital. They're invaluable tokens of future independence, options, flexibility. This ability to defer gratification, to build a robust buffer, that is, in my view, the bedrock against life's uncertainties. So, for financial well-being, our primary pursuit must be to diligently uncover and adhere to these underlying, often hidden truths about how money truly works, prioritizing substantive financial health over, performative displays.
Okay, I hear why you'd emphasize those hidden truths. And yes, understanding the nature of wealth is incredibly valuable. I won't argue that. But frankly, I think it pales in comparison to the pervasive influence of human psychology and the world's inherent unpredictability when it comes to our actual financial decisions. Our book's chapter, Reasonable Rational, really drills this home. Human beings just aren't cold, calculating spreadsheets. Mathematically optimal strategies, the ones a computer might spit out, frequently fail in the real world precisely because they completely overlook our emotional and behavioral realities. I mean, look at Harry Markowitz, the Nobel laureate in finance.
Right, the portfolio example.
Exactly. He famously didn't chase theoretical maximum returns with his own portfolio. He structured it so he could sleep at night. Now, that's a very reasonable approach because it accounts for human nature, for emotional comfort, which a purely rational model might just ignore entirely. Similarly, think about the widespread fever phobia, that often irrational fear of a fever itself, even though it's usually your body's healthy way of fighting infection. It demonstrates how immediate discomfort can completely override scientific rationality in decision-making.
Okay.
And then there's surprise, a chapter that profoundly reminds us that, quote, things that have never happened before happen all the time. Think about major economic shocks, 9/11, the 2008 financial crisis, the COVID-19 pandemic. They were largely unforeseeable, weren't they?
Generally speaking, yes.
Right. And that just underscores the futility of trying to make precise predictions. Ultimately, a realistic approach necessitates acknowledging our psychological quirks, our biases, and embracing a margin of safety,
embracing flexible thinking. Because, let's be honest, plans rarely unfold exactly as anticipated. This adaptive mindset, this psychological resilience, rather than perfect foresight or rigid adherence to theoretical optimal paths, is, for me, the more critical determinant of financial success.
I appreciate your emphasis on human psychology, I really do. But I think our psychological responses often stem from a deeper failure to grasp how wealth truly works in the first place. You see, the problem isn't just that wealth is hidden. It's that societal pressures actively push us, maybe even compel us, to spend conspicuously.
The pressure is real, yeah.
It is. The whole keeping up with the Joneses effect, constantly fueled by media and social platforms. It inflates our aspirations and can lead to a false sense of entitlement to lifestyles way beyond our actual means. This misdirection, fundamentally, comes from not truly grasping the core principle of wealth is what you don't see. It encourages individuals to prioritize visible consumption over invisible accumulation, and that leads directly, almost inevitably, to increased debt. The man in the car paradox illustrates this perfectly.
Ah, yes. The fancy car.
Right. Nobody actually thinks the driver of the fancy car is cool, but they imagine themselves as the driver, getting that admiration. It really makes you wonder, doesn't it, how deeply ingrained this desire for external validation is, and how it distorts our financial priorities in ways we might not even consciously realize. It's a fundamental misunderstanding, I'd argue, of what truly constitutes financial power and what actually brings long-term security.
I hear your point about societal pressures, and they're undeniably powerful in driving that conspicuous consumption, but I really question if it's just a misunderstanding of wealth's true nature. I'd argue these drives often tap into far deeper psychological needs and, frankly, deep-seated fears, irrespective of a rational understanding of wealth. Consider the cases of Rajat Gupta and Bernie Madoff.
Okay, where are you going with this?
Well, these weren't people who misunderstood wealth in the basic sense. They were already multimillionaires, genuinely wealthy by any definition, who then risked and lost everything for more. This isn't just about conspicuous consumption for status anymore. It's about the psychological trap of never enough, overriding any rational assessment of their existing wealth. They had it all by objective standards, but their psychology, their internal drive, demanded more.
The insatiable appetite.
Exactly. And what about the phenomenon of low-income individuals buying lottery tickets, despite the abysmal odds? The material points out that the poorest 10% of Americans buy the majority of lottery tickets. Now, is this necessarily a failure to grasp financial principles, or does it often highlight a desperate search for hope, illustrating how personal circumstances and the perception of limited options can lead to what might seem like irrational risk-taking? It's about a deep psychological need for a perceived way out, an emotional impulse that goes far beyond a simple misunderstanding of probabilities or compound interest.
That's a compelling point, and I absolutely agree that deep psychological needs play a massive role, no question. But even if we understand these hidden truths and the psychological pitfalls, it's not enough if we can't actually stick to our financial principles when things get tough.
Right. The endurance factor.
Exactly. This is where the value of reasonable, rational really shines from my perspective. It's about creating strategies that are truly sustainable for us as humans, not just for algorithms. Think about it. An investor's ability to remain committed to a strategy, especially during those difficult, lean years when the market is falling, when everything feels wrong, that's a far greater predictor of long-term success than theoretical perfection. Practical choices like home bias, where people might prefer to invest in companies from their own country, maybe not perfectly diversified but familiar.
Feels safer, perhaps.
Perhaps. Or even making small, discretionary stock picks. These can be perfectly reasonable if they sort of scratch a psychological itch without derailing a sound overall plan. These little allowances, these human concessions, they enable long-term commitment. It's this acceptance of our human fallibility and building strategies that accommodate it, even if they're not mathematically optimal on paper. That's crucial for actual, sustained performance. It's really about endurance over flawless, but perhaps brittle execution.
I can certainly see the appeal of reasonable strategies that make it easier to endure. Absolutely. But behavioral endurance, while essential, must be underpinned by a clear understanding of the unseen costs of investing. This is critical. As the chapter Nothing's Free so clearly articulates, market returns demand a price, a real cost.
Okay, the price.
Yes, and that price isn't just money. It's volatility, fear, doubt, uncertainty, regret, all those uncomfortable emotions. What often happens is that many investors try to get the return while avoiding the volatility. They're constantly attempting to time the market by selling before recessions they think are coming, buying before booms they hope are starting.
The siren song of market timing.
Precisely. And this failure to recognize volatility as a necessary fee, the admission price you pay for the experience of long-term gains, rather than seeing it as a fine for doing something wrong, that is a fundamental misinterpretation of how markets actually work. Without this deeper understanding, even a perfectly reasonable person following a reasonable plan is likely to abandon their strategy when the market inevitably turns, when that volatility hits hard. Why? Because they'll perceive those market downturns as punishment or a sign they made an error, rather than simply paying the unavoidable price for playing the long game. It's like knowing the ticket price at Disneyland is a fee for the experience, versus thinking it's a fine because you parked in the wrong spot. Different framing entirely.
Unpredictable. And you argue for understanding the mechanisms of change. I'm not convinced that focusing on how things change gives us enough preparation for the truly unexpected, the things that come completely out of left field.
The real surprises?
Exactly. The material in Surprise profoundly illustrates that the biggest financial threats often come from these unknown unknowns. Think about that story Housel tells about the German tanks defeated by mice at Stalingrad.
The mice and the wires.
Right. It wasn't about military strategy. It was about mice eating the insulation off tank wires, an utterly unforeseen non-military factor crippling a powerful force. This type of event, utterly outside any rational planning or understanding of predictable mechanisms, fundamentally shifts the focus, for me, from predicting how things might change to simply being prepared for them to change in unimaginable ways. Therefore, focusing on preparedness rather than prediction is absolutely paramount.
So robustness over prediction.
Precisely. Room for error, a margin of safety in financial planning, is essential to, quote, withstand any swings of bad luck and ensures one can keep playing until the odds fall in your favor. This means saving more than you think you need, maybe assuming lower than average returns in your planning, maintaining liquidity not for a specific expected event, but for the inevitable surprises that simply cannot be imagined or quantified ahead of time. It's about building robustness, not trying to refine foresight.
I hear your call for robust preparedness, and the idea of room for error is certainly compelling for handling the unexpected. But let me push back a bit on the idea that prediction is entirely futile. While we absolutely can't forecast specific events, the what? Understanding the mechanisms of change and the structural realities of economics is profoundly crucial for genuine resilience.
How so?
Well, think about compounding growth, which the book discusses earlier, or the long tail phenomenon, where a tiny fraction of outcomes or investments account for the vast majority of success, like how a few blockbuster movies make almost all the money for a studio. These are fundamental dynamics. They require understanding, not just a reactive brace for impact. Benjamin Graham, the father of value investing, despite his fame and foundational principles, he constantly updated his formulas because he knew things changed. It's not about predicting the what, the specific surprise event, but understanding the how of economic evolution, the underlying forces at play, and then adapting one's framework accordingly. That's what enables truly resilient decision-making, I think. If you understand how markets generate returns over the long haul and what the inherent costs are, you're better equipped to handle the what when it inevitably surprises you. It's about building a better compass, perhaps, not a crystal ball.
So for me, wrapping this up, a deeper appreciation for the hidden architecture of wealth, understanding that true financial power resides in what is unseen, meticulously accumulated through diligent savings and earned by consciously paying the inherent fees of the market. That provides the bedrock of sound financial decision-making. It enables long-term security. It's about cultivating a profound, almost counterintuitive financial literacy.
And for me, regardless of how profoundly one understands those financial principles, the world's inherent unpredictability and our undeniable human psychological biases demand that we prioritize flexibility, resilience, and a steadfast commitment to reasonable strategies over perfectly rational ones. That's what ensures our survival, our ability to stay in the game through those inevitable surprises. It's really about acknowledging our human nature in a complex, ever-changing world.
Both our perspectives, I think, underscore that financial navigation is far from a static equation. It's a continuous journey of learning, of adaptation.
Definitely. And ultimately, it leaves each of us to weigh that ongoing tension between insightful understanding and adaptive action in our own financial lives.
Today, we're diving into a really crucial tension at the heart of financial planning, inspired by Morgan Housel's The Psychology of Money. We're specifically looking at the core ideas in, I believe it's chapters 13, Room for Error, and 14, You'll Change. The central question we're wrestling with is this. In long-term financial planning, is it more critical to prioritize building room for error to withstand unforeseen external economic shocks, or to cultivate flexibility, to adapt as your own personal goals and desires inevitably shift? I'll be making the case for the primacy of, robust systems and buffers that help us survive external uncertainties and provide the foundation for growth.
And I'll be arguing that acknowledging our own personal evolution is actually paramount, advocating for strategies that prioritize adaptability and, the freedom to change course without deep regret.
Right. So when we talk about financial success over the long run, it really fundamentally boils down to one thing: survival. We live in a world that constantly throws unexpected surprises our way. The book makes this point so powerfully, reminding us that things that have never happened before happen all the time. The real challenge isn't planning for the obvious risks, the ones we can sort of model, but bracing for the things that are too crazy to cross your mind. I mean, think about those German tanks stopped by field mice in World War II. Who plans for that? Or, the completely bizarre issues startups encounter, things like a flooded office derailing operations or an unexpected mental breakdown among key people. These aren't just statistical outliers. They're often totally novel, black swan events that will utterly devastate even the most meticulously crafted financial strategy.
Okay.
Ariel beautifully articulates the biggest financial gains, the truly life-changing ones. They occur infrequently, either because they don't happen often or because they take time to compound. Compounding, that, eighth wonder of the world, it only works if you can give an asset years and years to grow. That sustained endurance, that ability to just stay in the game long enough for the magic of compounding to really kick in, that is precisely what a margin of safety provides. Consider the disciplined blackjack card counters mentioned. They know it's a game of probabilities, not certainties, right? And they always keep at least 100 basic units on hand. Why? To withstand any swings of bad luck, to ensure they don't get wiped out before the odds eventually turn in their favor. It's not about winning every single hand. It's about having the capital to play enough hands.
Right, to stay at the table.
Exactly. And we see this at the highest levels of finance, too. Bill Gates, back in Microsoft's early days, famously insisted on maintaining enough money in the bank to pay a year's worth of payroll, even if we didn't get any payments coming in.
Wow. Yeah.
And Warren Buffett, a titan of long-term investing, personally pledges to always run Berkshire with more than ample cash. He once said, "When forced to choose, I will not trade even a night's sleep for the chance of extra profits." Now, these aren't just technical safeguards. They illustrate, I think, a profound understanding that the mental and emotional capacity to endure is just as vital as financial solvency. This approach fundamentally protects against ruinous risk, like the Russian roulette analogy in the book, where no potential upside is worth that catastrophic downside. It cultivates what Housel calls a barbell personality. Optimistic about the future, definitely, but pragmatically paranoid about anything that could prevent you from actually getting there. It's about ensuring you live to fight another day, guaranteeing your future self, has a future self to worry about.
Okay, I understand the allure of that robust defense, and it's certainly a compelling argument for prudence. However, I'm not convinced that safeguarding against external shocks is the primary concern for long-term financial planning, especially when we consider the landscape of our own internal world. My perspective is that our desires, our values, our life goals, they are far from static. Basing rigid financial plans on some fixed idea of who we'll be in 10, 20, or 50 years is, I argue, often counterproductive. This brings us to what psychologists term the end of history illusion. The book brilliantly points out that an underpinning of psychology is that people are poor forecasters of their future selves. We regularly make decisions that will profoundly influence the lives of the people we're going to become, and then when we become those people, we're not always thrilled with the decisions we made. It's a fascinating idea, isn't it?
It is, yeah.
This phenomenon means that basically from our late teens all the way through our 60s, we consistently underestimate just how much our personalities, our desires, our fundamental goals are likely to evolve. And clinging to plans made by a past self, that creates what are essentially sunk costs. These are, as the book describes them, a devil in a world where people change over time. They make our future selves prisoners to our past, different selves, and the outcome? Potentially profound regret. Daniel Kahneman's approach, highlighted in the material, is really instructive here. His ability to just abandon extensive past work, declaring, "I have no sunk costs," that's a powerful model for adapting to new information or insights, even when it means letting go of a huge investment of time and effort.
That takes discipline.
It really does. And think of the poignant story of the doctor whose lifelong dream profession became for them an awful career due to the relentless stress and long hours. That's a powerful illustration of how even deeply held aspirations can change. Or, consider the simpler analogy. A 5-year-old wants to drive a tractor, but that same person as a teenager wants to be a lawyer. Life paths are not set in stone. Derek Sivers' story resonates deeply here, too. Achieving financial independence with a modest $12,000 at age 22 was, for him, far more life-changing than selling his company for a massive sum later on. It just underscores that enough is entirely relative, and maybe more importantly, it can be achieved much earlier with the focus on flexibility rather than just relentless accumulation.
So, to truly counteract this internal unpredictability, I believe the solution lies in cultivating balance at every point in your life. This isn't just about avoiding future risks. It's a strategy to avoid future regret and encourage endurance by building in moderate annual savings, ensuring you have free time, a manageable commute, quality time with family, the things that make life worth living now. It's about creating the capacity to change what you're doing on your own terms whenever you're ready, without being held hostage by decisions you made years ago as a fundamentally different person.
I appreciate that perspective on the end of history illusion. It's a truly fascinating psychological insight, and I certainly acknowledge that our internal desires are far from fixed. We all evolve, absolutely. But here's where I see the fundamental tension. Without the foundational stability provided by that robust room for error, that true flexibility you advocate for, the ability to adapt to a changing self becomes, frankly, almost impossible.
How so?
Well, think about it. The book points to money's greatest intrinsic value being the infinite ROI of controlling one's time, right? That's back in chapter 7. And that control, that priceless freedom, is ultimately enabled by savings, as discussed in Chapter 10. Savings, in this context, are a core component of room for error. When you save money without a spending goal, it gives you options and flexibility, the ability to wait, and the opportunity to pounce. This is precisely what allows for those crucial shifts in career or lifestyle when your personal desires change. If you want to take a year off to explore a new passion because your values have shifted, well, you can't do that if you're living paycheck to paycheck, no matter how much you wish you could be flexible.
Okay, I see the link.
And consider a sudden, unforeseen external shock, a major economic downturn, a personal health crisis, maybe an unexpected job loss. If something like that wipes out your financial standing, then this entire debate about adapting to a future self becomes kind of moot, doesn't it? Survival through these external shocks is a fundamental prerequisite for any form of long-term happiness or self-actualization. Without that secure base, the ability to pivot careers or redefine priorities, as you suggest, isn't just constrained, it can be entirely eliminated. You simply cannot adapt if you have nothing left to adapt with. Room for error isn't about rigid adherence to some past plan. It's about building the financial strength to be able to change your mind when the time comes.
I understand the argument for that foundational buffer, and yes, the examples you've given for survival are powerful. But my concern is that an overemphasis on building room for error against potentially distant, often low-probability external risks can inadvertently lead to a rigid life, a life of perpetual deferral of gratification. You're constantly accumulating wealth for this future self that, well, might not even value what you've so painstakingly accumulated. And that, I'd argue, creates its own kind of ruin, the ruin of regret or maybe an unfulfilled life. If the world is surprising due to external events, as Chapter 12 highlights, then so too is the self surprising, and arguably more consistently surprising over a lifetime. A truly effective financial plan, then, has to anticipate both, wouldn't you say? Both the external black swan and the internal shift in values?
Well, anticipating both is the ideal, but one seems foundational.
Maybe, but hear me out. You mentioned savings providing flexibility, and I agree up to a point. But I think we need to carefully define what enough savings looks like. Your focus seems to lean towards maximizing that buffer, perhaps. However, have you considered how people like Derek Sivers found their sweet spot of financial freedom with a relatively modest amount? It demonstrates that maximum accumulation isn't always synonymous with maximum happiness, especially if it means sacrificing your current time and control. Flexibility isn't solely about surviving economic downturns. It's just as much about surviving internal transformations without being anchored by past decisions or accumulating unnecessary sunk costs in a life path that just doesn't resonate anymore. The ability to pivot careers or redefine priorities because your values have genuinely shifted is, in my view, as vital as avoiding bankruptcy.
Without that internal adaptability, you might be financially solvent, sure, but personally unfulfilled, trapped by the choices of a past self you no longer even recognize.
I see why you might frame it that way, and I absolutely agree that the concept of enough is crucial and, often misunderstood. My argument for room for error isn't about advocating for endless, rigid accumulation or deferring all gratification indefinitely. Not at all. On the contrary, it's precisely about creating the capacity for genuine choice. It's the buffer that allows for true flexibility rather than sort of an illusion of it. Without that financial buffer, changing careers, pursuing new interests, taking time off when your desires shift, it doesn't become a choice, it becomes a financial impossibility for most people.
Okay.
The book discusses this concept of the unseen return on wealth from savings. That cash sitting in the bank, maybe even earning 0% interest on paper, might actually generate an extraordinary return if they give you the flexibility to take a job with a lower salary but more purpose, or wait for investment opportunities. This isn't just about weathering a storm, it's about enabling personal growth and fulfillment. It's the pragmatic resilience that allows for true, unforced personal evolution. It gives you the freedom to say no to a demanding job that no longer aligns with your values, or yes to an unpaid passion project because you have the financial runway. Without that runway, your internal desire to change just hits the hard wall of external constraint, the need to maintain a certain income. It makes your flexibility an empty promise. My position is that you must secure that foundation first. Only then can you genuinely build the structure of adaptability and truly pursue who your future self wants to be. It's the stability that, perhaps paradoxically, unlocks real freedom.
That's a compelling point about the unseen returns of flexibility, and I don't disagree that a solid foundation can facilitate choice. But here's where I think we diverge slightly. If that capacity for choice becomes an ever-receding horizon, constantly influenced by social comparison, which Chapter 3 talks about, where one perpetually defers gratification, always needing a bit more buffer, then the room for error can in fact become a trap. The book notes that happiness, as it said, is just results minus expectations. If your expectations for external security lead to constant striving, to always needing more buffer, always more room for error, and perpetually deferring the life you actually want now, it can undermine the very happiness and control over time that wealth is supposed to provide in the first place.
The comparison trap is real.
It is. Many people find themselves in a cycle where they accumulate more, sure, but their lifestyle aspirations also inflate right alongside it, leaving them feeling no more secure or free than before. Their room for error grows, but so does their perception of what's necessary, kind of negating the freedom it was meant to provide. The balance, therefore, I believe, must prioritize embracing a moderately fulfilling life now, with the understanding that goals will change, rather than over-preparing for every possible external event at the expense of one's current self. If the pursuit of room for error means you sacrifice the flexibility to live authentically and explore who you are today, if it means pushing off your dreams for a tomorrow that might never fully arrive, or frankly might not even be appreciated by a radically different you, then it risks leaving you wealthy in assets but ultimately poor in lived experience, and ironically, ripe with regret. It's really about finding that sweet spot where preparedness doesn't become paralyzing, you know?
This has been a really insightful exchange. It definitely highlights the complex interplay between preparing for external unpredictability and adapting to internal personal evolution in financial planning. My position, as we've discussed, really emphasizes that a robust room for error provides the bedrock for financial survival. It protects us against those unforeseen shocks and enables the powerful forces of compounding over the long run. And this resilience, paradoxically perhaps, can create the fundamental freedom necessary for future choices. It ensures that when your internal compass shifts, you have the stability and the resources to actually adjust your course without being completely shipwrecked by external forces.
And I've underscored that a flexible approach, one that's unburdened by sunk costs and overly rigid long-term goals, is absolutely essential to accommodate our inevitable personal changes. True financial wisdom isn't just about surviving the market's volatility. It's about giving ourselves the liberty to redefine success and happiness as we grow and evolve. It's about ensuring our financial plan serves us, rather than us serving some plan we made for a past self we barely remember.
Ultimately, Morgan Housel's work, I think, really suggests that managing money is as much about psychology as it is about math. It's clear there's no single, universally right approach here.
Indeed. The ideal strategy will undoubtedly depend on an individual's unique situation, their values, and importantly, their evolving understanding of themselves and the world around them. There really is no one-size-fits-all solution, but a thoughtful consideration of both perspectives, planning for the unknown outside and the unknown within, is invaluable in navigating the ever-changing landscape of financial life.
Today, we're diving deep into a really fundamental tension in personal finance. When we make decisions about our money, are we actually better off prioritizing rigorously rational, mathematically optimal strategies? Or should we maybe lean into psychologically reasonable approaches that offer peace of mind and, crucially, long-term adherence? This isn't just, an abstract question. It's a central theme illuminated in our source material, The Psychology of Money.
Exactly. And it's a tension everyone grapples with, I think.
Right. So I believe that for true financial success, especially over the long haul, embracing logic and data-driven methods is absolutely paramount. It's about aligning our choices with the objective truths of how money works to, maximize wealth and achieve our goals.
Whereas I view it from a slightly different angle, I'd posit that human behavior and our inherent emotions are not just factors to be managed, but they're integral to money management itself. So for me, reasonable strategies, even if they're not mathematically perfect, right, are ultimately more effective precisely because they acknowledge and, frankly, work with the complexities of being human.
Okay, well, let's lay out the positions. Financial success, particularly when we talk about building wealth over decades, unequivocally hinges on adhering to mathematically sound principles. The material itself highlights how academic finance is, quote, devoted to finding the mathematically optimal investment strategies,
and is typically taught as a math-based field. Now, this isn't about being a robot, obviously. It's about recognizing the mechanical advantages of disciplined application. Think about the profound power of compounding, a concept that's purely mathematical. Warren Buffett, for instance, accumulated an astounding 99% of his wealth after age 60. That wasn't luck. That was the relentless, almost formulaic benefit of consistent, rational application over a very extended period. The material makes it clear it's not what are the best returns you can earn. All that matters is what are the returns that you can sustain for the longest period of time.
Sustain, yeah.
Exactly. And this isn't just for financial titans either. The boring, bland, average way to invest, low-cost index funds consistently for decades will almost certainly end up in the top 1% of investors. That seems like a clear, data-driven path. Conversely, so many financial pitfalls arise precisely when we neglect this rational assessment. The tragic example in the book of the tech executive who recklessly borrowed for an extravagant home, ultimately leading to bankruptcy, or even throwing gold coins into the sea. It starkly illustrates the dangers of emotional or impulsive choices. Similarly, the insight that 99% of new crypto projects will likely fail underscores the rational need for diversification and, frankly, skepticism over speculative hope. So, while I absolutely acknowledge our human tendencies, the aim must always be to identify and apply the most effective strategies, leveraging data and evidence to overcome inherent biases, and thereby promoting genuine financial well-being more broadly.
Okay. I appreciate your focus on the quantifiable logic, I really do, but I come at it from a fundamentally different place. The core reality of human behavior simply makes purely rational financial decision-making unrealistic and often, frankly, counterproductive. The material is very direct about this, reminding us, quote, "You're not a spreadsheet, you're a person, a screwed-up emotional person." And it goes on to advise, do not aim to be coldly rational when making financial decisions. Aim to just be pretty reasonable. What seems crazy to one person might make perfect sense to another because our individual experiences profoundly shape our financial views. Different generations, unique upbringings, even the economic conditions we grew up in lead to wildly different beliefs about money. That makes a universal, rational approach not just impractical, but potentially damaging.
Consider the compelling analogy provided of Dr. Wagner Jodrig's malariotherapy. Here, fighting fevers, even if they might offer some marginal scientific benefit in certain conditions, is reasonable because, fevers hurt and people don't want to hurt. In finance, this translates directly to maximizing how well they sleep at night rather than obsessing over theoretical optimal returns. Things like home bias, that common tendency we have to favor investments in our own country, often to the exclusion of better global opportunities, or even like small-scale day trading, aren't strictly rational by academic standards. Yet they can be entirely reasonable if they satisfy a psychological need, scratch an itch, or maybe foster a necessary commitment to a broader, more diversified long-term strategy. The material even shares how Jack Bogle, the pioneer of index funds himself, invested in his son's high-fee fund for, quote, family reasons. Savings, in this view, are just for future spending. They're little tokens of independence, offering time to think and flexibility. This psychological benefit, this feeling of control and peace of mind, can yield an extraordinary return, even if the money earns 0% interest sitting in a bank account. Even the example of the poorest Americans buying lottery tickets driven by a glimpse of hope, when really all their options are bad, demonstrates that human needs and desires for psychological well-being often precede or override purely rational calculations. We are just not logic machines.
Okay, I understand your emphasis on the human element, and I absolutely agree that a strategy must ultimately be sustainable. But I would argue that the optimal strategy is inherently one that can be sustained. I mean, if psychological factors lead someone to abandon a plan, then the optimal plan, by definition, must account for human fallibility in its design, while still providing the highest probability of wealth creation. The mathematically optimal approach provides this highest probability, right? And it's only undermined when individuals fail to adhere to it due to emotional weaknesses, not because the strategy itself is flawed. The problem isn't with the map. It's maybe with the traveler deviating from it. The issue then is one of discipline and consistent execution, not an inherent defect in the strategy itself. The consistent success of low-cost index funds, for example, relies entirely on their unemotional and systematic application over extended periods. Their very boring nature is precisely what makes them optimal, perhaps, as it removes the psychological temptations, the urge to chase hot stocks or panic sell, that often derail more complex, supposedly sexier strategies. True optimization isn't about chasing the highest theoretical return for a single moment, but about achieving the highest realized return over a lifetime, which requires adherence to a proven, rational method.
I appreciate you bringing up the realized return, but doesn't that become purely theoretical if it doesn't account for how we as humans actually behave? I mean, optimal without adherence is purely academic, isn't it? Reasonable leads to practical success because it prioritizes sticking with it. The material itself offers a powerful counterpoint with Harry Markowitz, a Nobel laureate no less for his work on mathematically optimal portfolios, who admitted he invested his own money for his peace of mind, not strict optimization. He deliberately chose a less optimal approach because it was reasonable for him and allowed him to sleep at night. He understood that his own emotions were a factor. The book states it pretty clearly. The reasonable investors who love their technically imperfect strategies have an edge because they're more likely to stick with those strategies. Endurance, or the ability to stick around for a long time, is what makes the biggest difference, overriding short-term mathematical optimization. If a perfectly rational plan causes so much anxiety or discomfort that an individual abandons it during a market downturn, or maybe simply can't bring themselves to start it, how can we possibly call it optimal in any practical sense? The reasonable plan, even if statistically inferior on paper, is surely superior if it can actually be maintained through life's inevitable ups and downs. Wouldn't you agree that the plan you follow is always better than the perfect plan you abandon?
I completely agree that adherence is critical, yes, and the plan you follow is paramount. However, my point is that emotions, while undeniably present, are best categorized as perhaps flaws, biases, and causes of bad behavior that can and should be understood and managed. The goal here is to make better financial decisions, not just comfortable ones, right? Ignoring emotions altogether would be naive, certainly, but actively designing strategies to counteract them allows for a closer approximation of rational behavior, leading to demonstrably better outcomes over the long term. For instance, diversification. That's a rational strategy designed precisely to mitigate the seduction of pessimism during market downturns, or, the irrational exuberance of a bubble. It's about building systems that acknowledge our emotional wiring, but guide us towards a more logical path, rather than simply surrendering to every impulse. By recognizing and compensating for these biases, understanding our human programming errors, if you will, we can still achieve financial well-being that aligns with objective, wealth-maximizing principles. It's about leveraging our intellect to, outsmart our own emotional shortcuts.
I'm sorry, but I just don't buy that emotions are merely flaws to be managed out of existence. I think that fundamentally misunderstands what it means to be human. The material reminds us people are neither rational nor irrational. We are human. Therefore, strategies must accommodate human emotions, not just attempt to suppress them. Drives like the desire for respect, the keeping up with the Joneses effect, or even the small personal indulgences, like the occasional lottery ticket you mentioned earlier, are powerful drivers of behavior. A strategy that allows for these reasonable human tendencies, rather than demanding their eradication, is far more likely to succeed in the long run, because it respects the screwed-up, emotional person we are. Forcing an individual into a purely rational straitjacket is, I think, likely to lead to rebellion, burnout, or simply inaction. Jack Bogle's investment in his son's higher fee fund for family reasons. That perfectly exemplifies how personal, emotional connections can reasonably override strict financial rationality. It's not about being irrational, it's about being human. And if a strategy asks us to be less human, it's probably doomed to fail for most of us. How can we call a strategy effective if it ignores such a fundamental aspect of human decision-making?
Okay, I appreciate your perspective on integrating the human element, really. But when it comes to risk management effective strategy,
in my view, still primarily involves foresight, analysis, and mitigating quantifiable threats. While surprises absolutely happen, historical data and analytical models offer robust frameworks to anticipate and prepare for common market fluctuations and economic cycles. Understanding past recessions, for instance, provides invaluable lessons that inform strategies for future downturns. Neglecting this data-driven risk assessment can lead to catastrophic losses, as we've seen with leveraged investors during market crashes who ignored clear historical patterns of market volatility. To suggest we cannot predict any risks feels like, an abdication of responsibility. We can predict that markets will fluctuate, that economies will have cycles, and we can model the impact of these events, allowing us to build portfolios that are resilient against foreseeable challenges. It's about being proactive with what we can know, rather than just throwing our hands up at the unknown.
That's a compelling argument for mitigating known risks, definitely. But have you considered that, quote, risk is what's left over when you think you've thought of everything? The material powerfully illustrates that the biggest risks, the truly disruptive ones, are often too crazy to cross your mind. The historical example given of field mice defeating German tanks at Stalingrad because they gnawed through insulation and sabotaged wiring, it's a stark, almost absurd reminder of how the utterly unpredictable can derail the most rational and robust plans. Therefore, the more effective approach, I'd argue, is to invest in preparedness, not in prediction. This means cultivating room for error, like having what feels like too much cash in a bank account, even if it earns 0% interest, or adopting a genuinely frugal budget to withstand unforeseen events. The material specifically points to events like 9/11, a housing boom and bust, a financial crisis, a coronavirus, as things no one could have reasonably foreseen. Attempting to predict these truly unpredictable black swan events is, well, it's a fool's errand. This psychological buffer, this emphasis on resilience and having optionality, provides endurance, which is paramount for long-term survival and success. Far more so, I believe, than any attempt to quantify and predict the truly unknown. It's about being anti-fragile, not just prepared for the last crisis we saw.
Okay. I understand the value of room for error for unforeseen events, and I agree that extreme resilience is vital. But wouldn't building that room for error itself be a rational decision based on the statistical understanding that some unforeseen event will occur even if we can't name it? It seems to me that even your approach to preparedness is rooted in a rational assessment of probability, acknowledging the limits of our prediction, but still making a logical choice to mitigate unknown unknowns.
Well, perhaps the decision to build room for error is rational, sure. But the amount of room for error that feels sufficient, that truly provides that peace of mind we talked about, that's deeply personal and often beyond pure mathematical calculation. What feels like too much cash to an accountant might feel like barely enough to someone who, lived through a severe economic downturn. That sense of security, which is fundamentally a psychological comfort, drives the decision to hold what might be mathematically suboptimal amounts of cash. It's a reasonable, rather than strictly rational response to an uncertain world.
Okay. Well, we have explored this fascinating tension, debating whether financial decision-making should prioritize pure mathematical rationality or psychologically reasonable approaches. We've heard arguments for the crucial role of optimal strategies and the discipline required to execute them, exemplified by things like the power of compounding and the wisdom of systematic investing through, say, index funds. We've considered how true optimality might actually encompass sustainability.
Right, and conversely, we've examined how human emotions, individual experiences, and the fundamental need for peace of mind often dictate real-world financial choices, making reasonable strategies, even those that aren't perfectly efficient on paper, more attainable and sustainable for most people in the long run.
Exactly. Ultimately, this discussion reveals that while the numbers provide an essential framework for our financial journey, the human element profoundly shapes how those numbers are acted upon or even how they're perceived. It leaves each of us to navigate the complex interplay between cold logic and warm feeling in our own financial lives.
And there is certainly more to consider as we continue to understand this really multifaceted relationship between people and their money.
Today, we're diving into a really fundamental tension right at the heart of personal finance, that struggle between objective data and, well, subjective human experience.
Exactly. And the question before us really is, should individuals prioritize that cold, mathematical rationality in their financial decisions, aiming for optimal outcomes on paper? Or perhaps embrace a more reasonable, emotionally informed approach, one that maximizes for psychological comfort and, crucially, long-term adherence.
And this discussion, it stems from some rich source material that really explores the psychology of money, shining a light on the often conflicting desires for what is mathematically best and what's practically sustainable for us as humans. So I'll be arguing for prioritizing rationality and the pursuit of, well, demonstrably optimal financial outcomes.
And I, on the other hand, will present the case for prioritizing reasonableness and sustained adherence to a financial plan. Because, let's face it, what looks perfect on a spreadsheet isn't always what works in real life.
Right. And maybe we should clarify terms just briefly. So by rationality, I mean making decisions based purely on objective data, mathematical probabilities, and maximizing those quantifiable outcomes. This often requires us to set aside immediate emotional comfort.
Yeah. And by reasonableness, I'm talking about financial choices that prioritize psychological comfort, practical sustainability, and maybe a margin for error, recognizing that human behavior often deviates, sometimes significantly, from mathematical perfection.
Okay, so let me lay out my position. Finance, at its core, is taught as a math-based discipline. It teaches us to leverage data, probabilities, formulas, to dictate the most advantageous actions. Now, while we can't deny that human emotions play a role in decision-making, allowing them to override objective analytical reasoning almost invariably leads to, well, quantifiably suboptimal outcomes. Consider for a moment the historical practice of malariotherapy for syphilis patients. I mean, it was an incredibly uncomfortable, even dangerous treatment, causing severe fevers and distress. Yet, until penicillin came along, it was the most effective treatment available, leading to significantly better long-term health outcomes. Rationally, enduring that short-term profound discomfort for a dramatic long-term benefit was arguably the soundest approach.
I see the analogy, but...
Well, in the financial world, deviations from mathematically optimal strategies, even those made for emotional comfort, can mean leaving substantial potential wealth, security, or future options on the table. Prioritizing strict adherence to evidence-based principles, just as taught in academic finance, remains, I believe, the most reliable path to truly maximizing one's financial well-being over a lifetime. This isn't about ignoring emotions entirely, but rather ensuring they don't derail a demonstrably superior long-term strategy.
Okay, I come at this from a different perspective entirely. As the source material we looked at points out so well, individuals are not spreadsheets. They're inherently, quote, screwed up emotional persons. And to expect pure rationality in financial decisions is often both unrealistic and, I think, crucially unsustainable in the long run. The ultimate goal isn't just to have a financial plan, right? It's to stick with that plan for decades maybe. A reasonable plan, one that genuinely aligns with an individual's psychology, their comfort level, is far more likely to endure through market volatility, personal crises, evolving life goals, all of it. I mean, even Harry Markowitz, a Nobel laureate, a pioneer of rational portfolio theory, when asked about his own investments, he famously admitted he split his money 50-50 between stocks and bonds, not based on his complex math, but simply to, quote, minimize his future regret and help him sleep at night.
That is a famous example, yes.
It's a powerful admission, isn't it? A strategy that someone can actually commit to and sustain for decades, even if it's technically imperfect from a purely mathematical standpoint, will ultimately yield far greater results, I argue, than a mathematically perfect one that gets abandoned because of emotional stress, discomfort, or just an inability to tolerate its demands. Our emotional reality, not just our intellectual understanding, dictates our long-term financial success.
Okay, I understand the appeal of a plan that helps one sleep at night. I really do. But my concern is that we're allowing comfort to mask demonstrably inferior financial choices. How do we reconcile that feeling of reasonableness with the hard data showing strategies like home bias, where people prefer to invest heavily in companies from their own country?
Right.
Or even Jack Bogle's decision, famously, to invest in his son's high-fee hedge fund despite championing low-cost passive investing his whole career. These actions directly erode wealth. They are financially inefficient, they demonstrably reduce returns, and contradict the very principles economic finance holds as rational. True financial optimization, and indeed maximizing long-term wealth, often requires setting aside these emotional or relational considerations.
I hear the argument about mathematical purity, and yes, on paper, maybe those choices look suboptimal. But I would reframe them as reasonable, given the undeniable realities of human psychology and our social relationships. I mean, take Bogle's situation you mentioned. His decision wasn't purely about maximizing abstract returns. It was, as he said, for family reasons. He acknowledged that, quote, life isn't always consistent.
To ignore those deeply human elements is, I think, to build a financial model that just doesn't account for how people actually live. Similarly, that familiarity driving home bias, well, maybe it provides the psychological security needed for some investors to actually take the leap of faith and remain invested at all, rather than just sitting on the sidelines in cash, paralyzed. The true optimal strategy isn't just about the highest theoretical return, it's the one an individual can genuinely sustain without constant psychological strain or the risk of bailing out at the worst possible time. We often overlook the intangible benefits of money like flexibility, peace of mind, which are critical to long-term adherence, and frankly, a truly rich life, not just numerically superior returns. These aren't just feelings, they are integral to a plan's survival.
But is prioritizing psychological comfort not, in some cases, an abdication of responsibility when it comes to assessing and accepting calculated risks? I mean, a rational investor meticulously analyzes potential outcomes. If a strategy, let's say, has a 95% chance of success but a 5% chance of ruin, well, a rational approach would weigh the expected value, that is, the probability-weighted average of all possible outcomes, and make a calculated decision based on that. Being overly reasonable, as you define it, could lead to excessive caution, causing individuals to miss out on significant, well-calculated returns. Furthermore, not rigorously planning for known risks, even if they're uncomfortable to think about, leaves one incredibly vulnerable. We have to view the cost of success sometimes as the volatility we tolerate. It's a necessary fee for market returns, not some fine to be avoided through excessive timidity.
Okay, while I agree that calculated risk is absolutely part of finance, the reasonable approach fundamentally prioritizes, I would say, room for error and financial unbreakability above almost everything else. This isn't about avoiding risk entirely, not at all. It's about increasing one's chances of survival so that compounding, that eighth wonder of the world where your earnings earn returns, can actually work its magic over the very long term. You simply can't compound if you get wiped out.
Fair point.
Look at the cautionary tale of Jesse Livermore. A legendary trading genius, right? Became a billionaire multiple times, but also went bankrupt multiple times. His immense skill, without an equally robust capacity to simply stay wealthy, ultimately led to ruin. The source material highlights this beautifully with the author's personal decision to own his house outright. He acknowledges it was, quote, the worst financial decision, but the best money decision. Why? Because the psychological comfort and lack of mortgage payments provided the endurance, the mental capital to stay in the game elsewhere. You can plan for every foreseeable risk, sure, but it's often the unknown unknowns, those truly unpredictable events, like the example given of field mice disabling German tanks in World War II, that demand a margin of safety beyond pure mathematical rationality. Risk, as they say, is what's left over when you think you've thought of everything. My point is, even if it means foregoing some theoretical upside, ensuring your financial survival is perhaps the ultimate, most reasonable form of optimization.
I'm still not entirely convinced that prioritizing unbreakability at all costs is the most prudent path.
While survival is obviously key, a rational financial plan necessitates rigorous forecasting and setting clear long-term goals, even acknowledging we live in an inherently uncertain world. While we all know that things that have never happened before happen all the time, a rational framework still attempts to model possibilities, assign probabilities, however imperfectly, and adapt systematically when new information emerges. A reasonable approach, focused perhaps too much on immediate comfort or flexibility, might lack the disciplined foresight required for truly long-term financial security. It might not adapt quickly enough or efficiently enough to new vital information. This is about disciplined thinking to guide future actions, to avoid just drifting without a clear trajectory.
Well, I'd counter that. While planning is important, maybe the most critical part of every plan is to, quote, plan on the plan, not going according to plan. We are inherently poor forecasters of our future selves. Our goals, our values, our aspirations, they evolve dramatically over a lifetime, often in ways we simply can't predict today.
That's true, of course.
The source material gives that poignant example of a friend who achieved his lifelong dream of becoming a doctor, only to find the actual career awful, just soul-crushing. His rigid adherence to a rational goal set by a different person, his younger self, led to deep regret. What looked perfectly rational at 20 might feel like an unbearable burden at 40. Embracing change and maintaining no sunk costs, like Daniel Kahneman's approach to writing, where he could apparently just detonate what we had just done and start over, that seems like a more reasonable, flexible way to manage one's financial life. It allows for adaptation to an unpredictable future, and crucially to our own evolving personal desires. We tend to tell ourselves these complete narratives even with incomplete views, right? It makes us susceptible to appealing fictions about our own future, about the linearity of our desires. A truly rational plan, perhaps ironically, must account for the, irrationality of the human heart over time.
So this discussion today has really highlighted a profound and, I think, enduring tension in personal finance. I've emphasized the quantifiable benefits of a rational, optimized approach, cautioning that emotional deviations, while understandable, can lead to demonstrably less wealth and security over the long run. My argument is really for disciplined, evidence-based decision-making as the most reliable engine for maximizing that long-term financial well-being.
And I, on the other hand, have championed a more reasonable approach, arguing that human psychology and, crucially, long-term adherence are paramount. Recognizing that we are emotional beings, our financial plans need to be ones we can actually stick with through thick and thin, even if that means sacrificing some theoretical financial optimization for the sake of survival, for psychological comfort, and for the flexibility to adapt to what is inevitably an unpredictable future.
Ultimately, I think both perspectives offer incredibly valuable insights into managing wealth. The truly effective path forward for any individual may well lie in understanding both the rigorous logic of finance and the complex, often unpredictable nature of human behavior.
I agree. The goal, as we've explored, isn't just about accumulating money as a number on a page. It's about building a financial life that is sustainable, that's resilient, and that deeply aligns with one's evolving values and ultimately their sense of peace. The material we've drawn from today really invites each listener, I think, to consider their own unique definition of financial success and to find that delicate balance that works best for them on their own journey.